Hey, how's everybody from BiggerPockets? Dave Van Horn here from sunny Philadelphia. For those of you who don't know me, I'm president and CEO of PPR Note Company. And coming at you today with some how to get started in note investing. And our topic is, do I need an LLC or an entity to get started? So I'm going to be covering some of that. So if you're just joining me, hopefully you can hear me and see me and everything's okay. Maybe you can chime in and tell me where you calling, checking in from, what part of the country. I know we're in different time zones. We get people from around the world on these. It's pretty neat. So a lot of people have note questions. Feel free to ask note questions or make some comments. And I think I'll do my best to answer them. And we have a unique opportunity in the U.S. To invest in notes, and a lot of other parts of the world don't have that type of investment vehicle. So maybe you're coming from other countries, Canada or Australia or wherever, and all over the world, and they don't always have this opportunity that we have to invest in notes and mortgages. So feel free to ask questions. I understand that. And probably one of the most common is, do I need an entity or an LLC when starting out to own a note? Or I'm going to cover real estate as well. So I'm a big time real estate investor, and I I have a lot of entities. I know it's over 30. I don't know exactly how many. I'd have to sit down and count them. So I will get into, but it's really more important is, when do I need an entity? And I'm going to point some of that out. But before I get started, I want to do a little bit of a recap of what we did on the last Facebook Live for BiggerPockets. And it was just a quick recap on that. And we were covering the four main parts of the note business, which is administration, both internal and external, risk management, borrower management, and I think it was last week, we did exits. What are some of your exit strategies? And you know how they tell you should know your exit before you go into an investment, which is pretty wise, right? You should know your exits, right? So so let me give you an example of what we talked about, because last time we covered exits, and that was part 4. If you go back to YouTube, I'm sure you can catch some of these if you hadn't had the opportunity to join us. And exit strategies are simple when it's a performing note, right? You're collecting payments, or they refinance or sell, and you get paid off. We call that a cash out. You get cashed out before maturity sometimes, which usually your yield goes through the roof, which is cool. So, but more importantly, we covered when you have a non-performing note. And when you have a non-performing note, those exit strategies tend to be discounted payoffs, reinstatement plan. Sometimes it's a reinstatement where they bring the loan current and start making payments. Payment plans. There's all different types of payment plans where they might send money to arrears or back taxes. We talked about that. And then we covered refinance. If a borrower were to refinance and pay your mortgage off. We talked about seller assists, how we can assist the homeowner with assistance if they're trying to sell the property. We talked about deed in lieu. We talked about foreclosure. We talked about REO, which means you took the property back after a foreclosure sale. And of course, you can always sell the note, right? That's one way to exit a deal, just sell the note, right? So there's a lot of different things we talked about on the last one. So today, I do have to start out by giving a big disclaimer. Hey, I'm not an accountant. I'm not an attorney. So any attorneys and accountants out there, I'm not giving legal advice. Just giving, what am I giving? A little bit of wisdom, a little bit of my experience and my opinion, maybe. Really not opinion, more so experience. So let me see, who else do I got Matt Judge on the line there. What's up, Matt? And who else do we have? We have Nim, we have CJ, we have Michael, we have Yoko, Brian and Maryland. Let me see, who else can I see here today? A lot of folks joining us right now. So no, this is good because this question comes up quite a bit. Do I need an entity or an LLC to own a note? So my short answer to that is no, you don't need it. But then the other question is, should you? And then more importantly, when? When do you need it? And the answer is, it depends, right? So, and of course nobody wants to hear it depends, because then I start to sound like a lawyer or an accountant at that point, right? Well, when I say that, really, what is it for? What is the entity or LLC? A lot of times with real estate or notes, it's usually an LLC. It's pretty rare that you would see a C corporation. For most smaller investors, that type of thing, typically you're going to see an LLC to buy and hold real estate, or to buy and hold notes. If you were doing a lot of flipping, you might do a subchapter S corporation, which you can elect to be a C corp or an LLC. So, but no, we're not getting into all that. That's for the tax accountants and all that good stuff. So there are some considerations. We're going to touch on some of the things that I consider when I'm setting up an entity, things I look at. And you got to realize a lot of this is personal, right? Everybody's different. Everybody has different risk tolerance. Everybody has different assets to protect. We're going to talk a little bit about that. So really, I started out, when I get this question all the time, by the way, and I've probably written at least 2 or 3 blogs on the BiggerPockets main blog. So if you want to research any of those articles or whatever. So it really depends, right? And what's it for? What's your goals? What's your risk tolerance? And what is the real risk? What are you trying to do? And so whether it's notes or real estate, the other consideration is which master are you trying to serve, and how many of them are you trying to serve, right? So it can get pretty complicated pretty quick based on how complicated your life is, right? So that comes into play. But there's probably 2 main reasons people started an entity and that I think of, and one is obviously asset protection, and then sometimes they do it for anonymity, right? They don't want people to know that it's them, right? Or they want to, sometimes they want to look more professional, which is another good reason why it is a good idea if you are going to continue into any business, whether it's notes or real estate, that maybe you do want to consider an entity at some point. So I'm going to talk about that a little bit. And this is what worked for me. I'm not saying you should do this. This is what I'm saying worked for me, especially on the real estate side. So I'm going to talk about that probably at first, right? So for me, when I went out and bought properties, initially, I bought properties in my own name, and especially because a lot of it was finance driven. So we're in a finance driven business in real estate, right? So when you buy a property in your own name and it's under 10 properties, especially now, you're going to get better terms typically. You're going to get better down payments, you're going to get better interest rates, you're going to get a better length of the mortgage, that type of thing. So a lot of times, especially if you're buying owner-occupied or you have an FHA loan, and you buy a multi-unit and move out of it and then go get another property later on. So all these are important considerations as to what is your goal, how fast are you trying to build your portfolio, and especially under 10 properties, you're not going to need commercial financing. Once you need commercial financing, they're going to want you to, you might as well have an entity at that point. Now, the cost of having an entity is pretty nominal. It's usually $500 to $1,000 to set up most entities, and it's depending on your operating agreement is what makes the price differential. To do a tax return, it's a few $100, it's 500-ish, that type of expense. So it is a little bit of money to have the entity, right? But when do you get one, and do you really need one? So what do you do if you did have properties in your own name? And for me, I treated those initial properties in my own name as a separate bucket, right? And what I did, I did some things, because it was in my own name, some things that I considered to protect myself was I used debt as a form of asset protection. So I kept those properties pretty well leveraged. And even if I paid them down, I would typically put a home equity line of credit against it at some point to re-leverage it up, and then I would access that money and go and make another investment that might be in a commercial entity, right? So I had multiple buckets. I had multiple LLCs, but I still had properties in my own name from when I first started out. And I did that because I was getting better terms, and then I would quickly build my portfolio, and then I was off and running. So that's one strategy. Now, not everybody moves as fast as I did. And then, of course, today I have multiple entities and businesses and things like that. So, that's one strategy. So if you're having stuff in your own name, there's some things, 4 or 5 things you could do to give yourself a little extra protection because it is in your own name. And what I did was, and some people utilize trust too. Now, with trust, though, you got to be careful transferring in and out. In a state like Pennsylvania, where I'm from, there's transfer tax if you're moving in and out of trust. There's also, there can be expenses if you are, usually you're taxed at the beneficiary's rate, or you're taxed at the trust rate, which is high. It's a pretty expensive rate. So when you look at the tax considerations, it may or may not make sense for you. But that aside, and sometimes transferring the asset with a current mortgage in place, you could trigger a due and sale clause, which you may or may not really want to do. So it depends on where you're at and what you can do. So there's other considerations. So a lot of times if you're taking title to something, you're kind of leaving it there for a period of time. And then if you go to 1031 exchange your property, you have to keep the title the same. So you got to keep these considerations in mind sometimes. But for me, when I had some properties in my own name, I used debt as a form of asset protection. I increased my liability insurance. I utilized an umbrella policy for additional insurance coverage. And then titling. Sometimes you can title stuff, particularly in my state of Pennsylvania, where I could take title with my wife by tenants by the entirety. And if I was ever sued or anything, they really can't force the sale of that property. Doesn't mean they can't put a judgment, but they can't really force the sale because I own it by tenants by the entirety. So sometimes there's protections like that that some people are or not, they may or may not be thinking about, right? Now you also have to consider estate planning stuff, and I'm going to talk about that a little bit towards the end. But there's also some other things you can do to limit some of your risk, right? When it comes to the real estate side, you could. There's insurance for lost rents, right? There's some buddies of mine who aren't handy, for example. They'll utilize home warranties, and a home warranty might be $400 or $500 a year, and they'll actually have the deductible for the home warranty built into the lease, where the tenant would call the home warranty company and they would pay there's like a deposit amount, maybe $100 or something, the first $100. Well, they'll build that into the lease and it would cover plumbing, electrical. It covers everything usually but roofing. A lot of times they'll cover the heater and all that kind of stuff. So sometimes a home warranty is a great way to ensure, especially if you're not handy, right? So there's ways to limit risk, right? Another way is to utilize professional property management. Now, in the beginning, I managed my own stuff, and later on, I became a property manager when I was at a RE/MAX, and I would manage property for other folks. But that wasn't always the case. In the beginning, I managed a lot of my own stuff. Today, I utilize a property manager. Now, the advantage of that is they're compliant. They're screening people, they're checking people, they're doing it the right way. Hopefully they're not discriminating or any fair housing issues, those types of things. So there are a lot of rules to know. And if you're doing it yourself, I'm not saying don't do it yourself, but you're going to have to get dialed into what you are allowed and not allowed to do, right? Okay, so and then I talked about utilizing HELOCs in case equity started to appear in my property. I started to pay it down or the property went up in value, because I've owned property. Afraid to say this, since 1989. So I have properties that had considerable equity in them, and then I would access that equity with a home equity loan or a home equity line of credit. Sometimes refinancing them, but I've done it all those different options to access the money. And I've even sold property too. So, but I would keep my properties that were in my own name pretty well leveraged for the most part, and then reposition that capital into another investment. So that's one way to look at it. So let me see, if you guys are just joining us, I'm talking about, do I need an entity or not? Hey, there's Chris, and I see Kathleen is on. Wow. And Jay, all kinds of people are joining us. Chantel's here. So it's really cool that I get to chat with a lot of folks, and you can all chime in. Feel free to ask a question about, do I need an entity to do real estate, or do I need an entity to do notes? So that's kind of what we're talking about. Now, where am I? So the other question is, when do I need an entity? So you can see what I'm doing with the real estate. Eventually I did get entities to hold my real estate in. Some people have an entity to flip properties. Some people have an entity for different pieces of real estate or different types of assets. So I have different businesses in different entities. I have notes in a particular entity. I have separate entity for REO property. I have separate entity for buy and hold real estate, that type of thing, or commercial real estate, right? So I don't necessarily want to mix and mingle a lot of craziness. Now, when you're small, you might have, I have an entity that owns a little bit of property, and they also own a note or two. And I'm going to come back to that. But how do you decide when you need an entity, right? And part of what I'm getting to there is, it could be the size of the assets or amount, that you might go, I got $1 million in assets in this entity. That's too much, And now this is different for different people. Some people want a different entity for every single property. I don't know that makes sense unless they're pretty valuable properties, or they're, apartment complexes or something. You'll see, I have a lot of friends that I mess around with multifamily investments, and they'll have special purpose entities, and each apartment complex is in a special entity. That makes sense. It makes perfect sense. Builders do the same thing. Worked with a lot of builders over the years. Builder will typically have a different entity for every cul-de-sac, right? Mobile home parks, been involved in those with even series LLCs. I've done some of those. But, I really like separate entities for different projects, especially if they're decent size. When it comes to properties, though, do I keep 5 or 10 in an entity? Or, usually I'll have some type of limit, and then I'll think about opening up another entity, right? So sometimes it's size, and then sometimes I do it to separate risk, and sometimes I do it to, the characteristics of the asset. I'll segregate, because they have different risk levels. So I'll give you an example there. One time I had an apartment building. I was sued from someone that had a slip and fall. They sued me for $400,000 or $500,000. Well, I don't necessarily want that lawsuit in my note portfolio, or in my commercial real estate portfolio, or in my other business over here, or in my personal life, right? So you see how you want to segregate risk, and I call it that multiple bucket thing, where you have all these multiple buckets of risk in your life, and you can't really mitigate against every risk. You can try, right? There's certain things you can do, but you can't eliminate it across the board. But I can separate it, and I can segregate it. And you can even do that in your IRA accounts. You can have multiple IRA companies, and you can also have multiple IRA or qualified plans that they're actually separate entities as well, right? So there's a lot of ways to segregate your investments and your assets, so you can mitigate or limit some of the risk that's out there. Because there's always something going on out there. Somebody's trying to come after you for something. Maybe it could be anything, right? It could be a lawsuit, could be bankruptcy, could be all kinds of things, right? So, but when it comes to notes, a lot of people say, do I need an entity? I'm starting out in notes. And the answer is no. I mean, you can definitely do one in your own name, and I've done that. It doesn't look very professional, especially when they're institutional notes. If I bought a note from a bank, and picture a borrower that, they don't want to call Joe Blow or Dave Van Horn about a loan. They want to call some company about their mortgage on their house, right? I mean, now if you're doing seller finance notes, where I'm selling one of my rental properties to my brother-in-law. I think my brother-in-law might still be on the call. If I sell my brother-in-law one of my rental properties, then maybe I can hold a second mortgage, and that's just a private mortgage. Maybe it is in my own name in that case, because maybe that property was in my own name, and I hold a second mortgage to help him, buy the property with little or no money down, that type of thing. So there's some strategies there. So sometimes in the seller finance world, it might be more common to own a loan in your own name. But I think if you're going to have any kind of quantity of this, or it would be wise to have an entity, because what if you underwrote the loan wrong, or you did something that was a violation in your particular state, that they could come after you? Well, you want to at least mitigate that. You don't want them to come after everything you have or own or that type of thing. So it is wise to have an entity with notes. And probably one of the biggest reasons is some sellers, especially with institutional notes, they won't sell to you unless you have an entity. I believe PPR is that way today. So if there was a time years ago, especially before 2010 when Dodd-Frank was passed, it was a little bit of, I don't say the Wild West, but it was a different place. It wasn't as highly regulated. They weren't regulating small note owners and brokers like they regulate banks. Well, today they do. So if you're a note seller, you're actually responsible, especially for data transfer at the time of a purchase. So you kind of want to vet your note buyers. You want to know who they are, and you want to do the responsible thing there. So a lot of times it definitely looks a lot more professional if you have an entity and you plan on doing this business. Well, that's going to depend on what your goals are. If you're just trying to do, I'm just trying to sell my rental property, that's one thing. If I'm really trying to start a note business, by all means, I would absolutely consider getting an entity, meet with the attorney and your accountant or whatever, and get that set up the correct way right out of the gate. You're gonna be glad you did. The other piece I wanted to talk about was control versus ownership. But before I do, let me see if there are any other questions that I can see on here. What are notes? That's a great question. They're musical symbols. No, actually, when I refer to notes, I'm talking about notes and mortgages, which would be like the mortgage on your house, right? So most people understand what a mortgage on your house is. And I often joke with people that we're all in the note business. We just don't realize it. Your credit card's a promissory note, an unsecured note. Your auto loan is a secure note because they could come take your car, repossess it if you don't pay. So your student loan's a note. Medical debt is often a note. So we're all in the note space. We just, we're at the other side of it. We're writing checks to the lender. Whereas what I'm talking about today is when you are the lender, you are the bank. So great question though. Who else do we have? Anybody else? Getting a HELOC under an LLC is being impossible for me. It could be. Yeah, sometimes people take transfer title out of a trust or an LLC and then go get financing and then try to go back into a trust. I've seen people do that before. Any suggestions or lender you may know to get a HELOC under an LLC? Well, sometimes you could set it up as a business and get like a business line of credit. And I have had business lines of credit tied to real estate, and it could be residential real estate. I actually have a duplex right now where I have one of my entities, a business entity, has a line of credit, and it's secured to a piece of property that I own that is really a residential duplex. So it can be done that way as well. That could be an easier way maybe. I know, just because I mentioned HELOCs or home equity lines of credit or home equity loans doesn't mean they're always over time, doesn't mean they were always easy to get. Some time periods, different types of financing are easier to get than others over different time periods. I remember when I first started buying houses and fixing them up, it was almost impossible. I don't even know if HELOCs existed. I could only get a home equity loan. And in fact, I could get a home equity loan easier than I could get a mortgage, right? So it's because I already own the property, right? So there's some weird things. The one constant in finance and in lending is it always changes. That's the one common denominator. When I look over the years, I've been a realtor over 30 years. The one thing I know is I don't have the same loan officer I had when I started. They change. They change every 5-10 years. You get a whole different influx of people usually because the whole industry changes, right? So it's constantly changing. That's one thing I do know about finance. It's pretty rare that unless it's at a community bank or something, it's rare that you see the same loan officers any real long period of time. In fact, a lot of the loan brokers I know have been at multiple banks over the years. They might still be in the business, but they're working for a lot of different people. So LLC for holding multiple owner financed lots. Yeah, you could do that. You just got to be careful when you start to pool money. Are you a security or your private placement? So that's something to think about too. I was starting to talk about control versus ownership, and I mentioned early on, a lot of times people set up an entity for anonymity, especially with trust, because there's virtually no real asset protection with a trust. It just gives you some anonymity and puts up a couple barriers to make it a little more difficult to figure out who owns it, or how you can find out who the owners are or where they're at or who the beneficiaries are. It gets difficult, right? Because trusts are private. So it gives you anonymity, but not necessarily asset protection. An LLC, on the other hand, can kind of give you both, although the entity could be in the public record. But you could have an entity that's owned by a trust, because I have some of those, right? So there's a lot of different things you can do there. But you also have to take into consideration some of the estate planning aspects of it. So a lot of this can depend on your domicile, which is what state you live in, right? Or how much exposure do you have, and what is your exit strategy of the investor. So a lot of this goes into play when you're really thinking about these entities and what you're setting up, and who the owners are. Sometimes you have an LLC where the manager is another LLC, or a trust, and you can do several layers of that. But the one thing I do want to bring up about estate planning is that there is a 5-year look back, especially if you're passing assets on to heirs, that type of thing, especially if you go into Medicare, Medicaid, those types of situations. So there is a 5-year look back. You want to be aware of that. And that's why as you get older, you may not want to own everything. You might want to just control everything. And there's a big difference. So a lot of people that are successful and wealthy control things. They don't necessarily own things. Ownership is not always what it's cracked up to be, right? Ownership is what gives you all the risk, which brings all the risk into your life. So you can control a lot of things without owning them, and it can work very well for you. And keep in mind, money rarely passes more than 2 generations, right? And this is one of the reasons, because upon our demise, unfortunately or fortunately, most of our assets or money ends up in the tax man's hands, or in the nursing home situations, those type of things. So I don't think people plan to fail at this. I think they just fail to plan, or they fail to get the right help. And sometimes that help is well worth it, right? It's very nominal, 1,000 or two, or even, I don't care if it's 10,000. If it saves you 100,000, it's worth it, right? So I think a lot of times people don't want to think about it, or they don't want to think about estate planning, but it is pretty wise to consider about the possibility of not owning as much stuff, just controlling more stuff. And then sometimes it is better to pass, especially real estate where there's a stepped up basis. Sometimes it's better to keep it in your state. The only challenge is, how do you manage the property or take care of it as you get older? That's the hard part, right? And a lot of times your heirs or your children don't want anything to do with that. They don't want to do the work, right? So you got to keep that in mind. But when it comes to notes, do you have to have an entity? The short answer is no, but you probably should, especially if you plan to do it as a business. It's more professional. And like I said, some sellers won't sell to you. So hopefully this has been useful to you. I hopefully answered some people's questions. Here's a question. What's the difference between a home equity loan and a HELOC? Well, a home equity loan is a fixed rate. Usually, there might be 15, 20-year home equity loan. It's almost just like a mortgage. It's really usually a junior mortgage, like a second mortgage or a third mortgage. It might be for a 15 or 20-year term, and it's a fixed payment, fixed rate, defined length of time. A home equity loan tends to be adjustable. It fluctuates. It's tied to an index, right? It might be tied to the LIBOR. And then it fluctuates every, sometimes they fluctuate monthly, sometimes they fluctuate every 6 months, and they usually can't adjust more than, say, 2 points. But so basically your payment's not set. It can jump up and down. Now, I have had those types of loans where the bank will allow you to fix that rate at a later date, usually at a higher rate, and that's kind of what they play kind of games with that. But or you can refinance it and make it a loan. So some people prefer the loan, some people like the line of credit. The advantage of the line of credit is you don't have to take the money. So if you take a home equity loan, you're taking the actual cash. So I don't know, it's a $50,000 home equity loan. You took the money and you're starting to pay on it the next month, right? With a home equity line of credit, they might go, well, here's a $50,000 line of credit, almost like I hate to use this analogy, but it's like a credit card attached to your house. And, I have access to $50,000, but I don't pay on it till I go to use it. So if I write a home equity line of credit check, or I deposit I deposit $10,000 of the $50,000 in my account. Well, obviously I start making payments on the $10,000. But the thing that's different there is you're only paying on it when you use it, and the rate it fluctuates, right? So it's not a fixed rate loan. So that's the biggest difference in most of them. There could be some subtle nuance to some of them, but that's usually how the difference, and that's how they work. So hopefully some of this has been helpful for you guys. I know I'm trying to think what we have coming up. Oh, by the way, I do cover some of this in my new book, Real Estate Note Investing. You can get 20% off the book if you haven't picked it up. The code for that is Live Note Investing, all one word, Live Note Investing. You do get, there's bonus material. You get a free ebook called Stay Safe in the Note Business. There's also a video with Brandon Turner where we actually go out to websites and stuff. We look at notes. We look at performing, non-performing, first mortgages, second mortgages, and we talk through Brandon like he is brand new. Hey, Brandon, you want to buy a note? What are the things we look at, right? We've been doing this a little while. Also, there's audio Void Investing Mistakes with Mary Hart, an asset protection attorney. Great audio if you want to pick that up. You get those bonus materials with the book, Real Estate Note Investing. And a lot of what we've been talking about today is covered in Chapter 2. Chapter 2 of the book, we talk a little bit about some of these topics, about entity selection, when did I get different entities over time, because a lot of it's timing, right? What do you need when, right? If you're just starting out and you don't have any assets, well, there's not a whole lot to protect, right? I'm not saying you don't want to protect it, but you build your levels of protection as you grow, as the way I look at it. Now, I'm not saying I'm right. There's going to be people that say, hey, you need an entity to do everything, and you need, and usually, I get it. Everybody has a different opinion on it, but I found what worked for me was to keep, go get the desirable financing on the properties I could get in my name, treat that as one bucket, do some asset protection strategies with stuff I had in my own name, keeping it leveraged, those 4 or 5 things that I would do. And then I would often have my LLCs, and I have many, many LLCs today. So part of it was where I was in the game, where I was, what stage I was. And today, yeah, I have plenty to protect and plenty of assets to consider. But it's really back to what I said, which master you're trying to serve. You got to consider that, right? And you also got to consider the tax implications. What are the tax implications? And then as you get older, like me, right now, it's ownership versus control, and what kind of estate planning do I want to build into some of these things. So hopefully some of you folks enjoyed it. I know Jessica is giving me a thumbs up. If you could share this for me, I'd appreciate it. I'm trying to beat Brandon Turner in shares. It's not easy to do that, though. He's pretty popular. I'm not that sexy or popular as Brandon. I don't have the beard, So, but I do want to let you know our next Facebook Live will be on October 17th. I'm actually heading out to see Jake and Gino Multifamily Conference in Nashville this weekend. So if anybody wants to say hello to me down there, if you're in Nashville this weekend, that would be cool. Jake and Gino is pretty cool. They do a pretty cool podcast on multifamily, if you haven't caught that. And on the 17th of October, I'm going to be talking more about how to get started in notes. I'm trying to think, what is my topic for that? I forget now. But anyhow, we also, in November, we do a note investor Q&A call. If somebody's really rolling up their sleeves, doing non-performing notes, want to learn more about that, if you go to our website, pprnoteco.com, you can actually find out when our next events are and our next Q&A conference calls are. And or you can sign up for our e-zine. We send out a weekly email newsletter with a note for sale. There's a note in your inbox every week. If you're looking for a performing note to buy, by all means, sign up for our email newsletter. It's pprnoco.com. And we also have a new fund out. We have a new Reliant Liquidity Fund. And the cool part about a liquidity fund, it is only open to high net worth investors, but you can actually get your capital back with 90 days notice, which is a pretty cool feature. Not too many funds do that. There are some liquidity funds out there if you go to a Vanguard, but they're not as, what do you call it? Not as high a yield as we are. So great chatting with you guys today. Hopefully you enjoyed this talk on not so much do I need an entity or LLC to own a note or real estate, but it's really when do I need it and what does that strategy kind of look like. So obviously this was not legal advice or accounting advice. This was really just trying to get people to think about some of the questions that I asked myself and that I did over the years. And you might want to consider some of those same things to, when you go meet with your attorney or accountant, you might want to ask some of the questions that I brought up or triggered for you. But there's some food for thought in there, right? So thanks, guys. Thanks for joining me today. I look forward to seeing you after the multifamily conference. I won't be around next Wednesday, but the following Wednesday, I will still be talking about how to get started in notes. Thanks, guys.